All right, twice today we got questions in the community about deducting real estate losses. So this is a big one, and I get the question all the time, so I figured it was time to record another video on it, and hopefully this helps some of you who haven't even asked the question yet, but who have it. How do we deduct real estate losses? Generally speaking, the situation is going to look something like this. We have your individual 1040 up here. You might be single, you might be married. We'll get into the different tax consequences of each, but usually you're some combination of having an LLC down here, usually as like an S corp, where you're involved in some kind of business activity, and maybe you have some W-2 wages either from that S corp or from another job or a spouse's job or something like that. And then we have over on the passive side, we have another LLC, which is our family management company, and this LLC usually has a couple of, one or a handful of real estate properties underneath it. And you might have multiple LLCs, but they all effectively do the same thing. And so we're going to leave it at one just for simplicity's sake in this example. So let's say, again, for example's sake, that we've got somewhere around $300,000 of income coming in on the ordinary side. And then on the passive side, here's what we're looking at. I'm going to, again, just pick some numbers from people that I talked to today. So here we go. Let's say the property is valued around $500,000. That could be one or multiple, and that might include the actual purchase price plus leasehold improvements and things you've actually done to fix up the property, whether it's a rental. It's usually going to be a rental, short-term or long-term. But so $500,000 into the property. Let's say that this property is generating cash flow profit of roughly, $40,000. Okay. So we have $40,000 of profit coming in. And then we have, through some kind of accelerated depreciation, it could be accelerated depreciation on the actual improvements. Could be that you did a cost segregation study, but one form or another, let's just say on that 500, we're sitting here looking at like $150,000 in depreciation. Remember, we've already taken all the other expenses. That's what this profit number is. That's net of expenses. All right. So bottom line, we're looking at something like, $110,000 loss that we are trying to figure out what to do with. Remember, we've already wiped out this 40. So that's good news. We've wiped out that 40 of profit that otherwise we'd be paying taxes on that on top of the 300,000. But now we're sitting here staring at this $110,000 saying, man, I would really love to get access to this $110,000 loss and use it to offset my income of $300,000. But as many of you know, the issue is the $110,000 loss is passive. And the $300,000 income is ordinary. And that's like oil and water. They can't mix. We can't take passive losses against ordinary income. So we're left with basically three ways to get those passive losses out of that property. First one is the first one's pretty crappy. We can sell the property. So anytime you sell a property, it will release whatever passive losses are associated with that property. But that's not great. Presumably we just bought the property. We're not looking to sell it. And I don't want to wait 10 years to take my losses or to be able to claim my losses until maybe I sell the property. And so it's possible, but it's not great. And then if we sell the property, we might have a gain that offsets those losses. So there's just selling generally is not the best option. So then our next option is we can take this passive activity loss and move it to an ordinary loss. And there really are two different ways that we can do that. The first one is through something that is called real estate professional. So it can be real estate professional. In order to qualify as a real estate professional, this doesn't mean you have to have your real estate license. There are essentially 3 requirements. Most people think of them as 2 requirements, but I'm going to get into the third here because it matters. You have to spend at least 750 hours involved in the real estate. So that has to happen. It's a minimum you have to meet, and you really do need to keep track of those hours because the IRS will challenge them. So 750 hours. The second one is that the real estate has to be your primary source of income, and that one is the one that's really tough for people to meet. It works great if you have one spouse that works and the other one that is, for example, staying at home with the kids who can get involved in the real estate. So they don't have a W-2, they don't have anything else going on that would be a bigger source of income than the real estate. It has to be bigger than everything else together. So if you have a W-2 and a business, it's both of them together, and the real estate has to be bigger than that. But it's by spouse. So oftentimes, this works well where you have one spouse as the real estate professional. 750 hours. Main source of income is the real estate. And third is you have to actually make an election on your 1040 form when you file your taxes for that year. So don't forget the election. That's the one that's often overlooked, and and then if you miss that, then the other 2 don't end up mattering. So you've got to make that election. Be sure that you're remembering that third one. That's real estate professional. That turns that activity of real estate from passive to active or ordinary, and now it allows you to deduct those losses. They're ordinary, so you can deduct them against your ordinary income. So that's one way. The other one is something called an active investor. And this is much easier to qualify for in terms of actually qualifying for it. You just have to be involved in the business and be doing something active in it. And most people can cross that threshold. I'm not going to get into the weeds here on the specifics, but just that works. Except there's a limit on income. So it's $100,000 of income is when you start to phase out of this, and at 150 you're totally phased out of it. And as long as you're $100,000 or less, you can take $25,000 up to $25,000 in losses. So if your income's lower, you're just getting started, that's great. In this example, it doesn't really do us a lot of good. Maybe we could get there and take 25 of the 110, and we want to just hack away at it in those chunks. That would be great. But in this example, the income is so high, it's going to be difficult to get down to that $100,000 mark to do it. So oftentimes that's what we run into is you can't really qualify for the active investor rule just because you don't meet that $100,000 income mark, or the $25,000 is such a small piece of the potential deduction that it doesn't really do you any good. So the next way that we can get at this loss is by basically creating passive income. We need to add more income on this side of the equation so that we can have the income with which to offset the losses. This is a little bit more challenging sometimes, especially if it's all in 1 year and you've got the house. How do you all of a sudden create a bunch of income there? There is you can make strategic investments, like investing in a business that will have that is passive to you, where you're a passive investor in the business. And particularly if you're a passive investor in something like a franchise or something with startup costs, that will often create kind of a lump sum of passive losses that you can take in a year, and you can plan it to where it aligns with your real estate losses. So you can create passive losses, again, generally by investing into businesses as a passive investor. And that's very doable. But oftentimes it's also not practical and just isn't one size fits all solution. The other way to create passive income is to remove it from this little equation, or to add on to this equation. And this, just to make sure I'm giving credit where it's due, this is something that I learned from Tom Wheelwright, who's written some phenomenal books on taxes and tax and wealth planning. So I highly recommend those. But this actually involves creating a trust. And so what we're doing is shifting income away from this whole piece, putting it into a trust. And that trust generally would go towards your beneficiaries, so your children. That's the most common thing. And what you do is you shift some of the ownership percentages of the S corporation into the trust, and some of the ownership of the family management company owning the property into this trust. So in this example, let's just say we're going to shift 50% of the income from the S corp into the trust, and let's do 75% of the income or loss from the LLC into the trust. So those numbers are pretty easy. We've got $150,000 in income, and we've got 110. So that's like $82,000 of losses. So now we have within that trust, and honestly, I'm just doing these numbers off the top of my head. So that math probably isn't ideal. So we would probably design this a little bit differently to make those align. And it's also important to note on this front that this needs to be a long-term strategy. This isn't something you would just do in 1 year without giving any forethought to the coming years, because once you shift those ownerships, you've got long-term planning to think of. This works really well when you're investing consistently in real estate and building a real estate portfolio over your life. It doesn't work as well for just a one-time, 1-year thing. We bought a property, let's do this one thing, because now you have long-term consequences for a short-term deal, and you want to think through the long-term outcome of here. But shifting the income out of your own name doesn't mean shifting it out of your control. You can set the rules within the trust. You can determine when the trust when the trust actually shifts income. But this could be to help your kids start a business, or help your kids go to college, or help your kids buy a house. Things you might be helping them with anyway. Pay for weddings. Costs that might be coming out of your pocket anyway down the road, where you're helping your kids, but you're in the process shifting this income out of your name, still within your control, to the benefit of your children. And in doing so, what we're doing is taking income that would otherwise be ordinary to you and shifting it into the trust. And this income, key point here, this income is passive to the trust, as is this loss. And so what we've done is we've taken ordinary income, shifted it to passive income, along with passive losses that remain passive losses within the trust. And we would want to think about these percentages more carefully to get something close to aligning what we have here. So, probably would bump down the percentage that we're looking at here for this S corp, and get it to whatever that is. Something like 25% probably would be closer. And then these will come closer to balancing out. So the point is, you're getting this trust oftentimes is actually a taxable entity, but what you're doing is planning ahead to sort of control the amount of income that's shifting in there long term, so that you're essentially creating a wash within the trust from a tax perspective, but still creating a place to set aside income that, again, you have control over. And that's the key difference. A lot of times people will get hung up on tax strategies because they think, I don't want to put all my income in a trust. But think about where are you likely going to spend that income anyway, depending on where you're at in life and kind of what your goals are. This might be income that's going to be going to your kids one way or another. So we can shift money into this trust and have it be our college savings. We can shift money into this trust and have it cover things like weddings and first homes and all those things I mentioned earlier. So, but doing this and thinking about it proactively becomes very powerful, because now it lets us access that $110,000 in losses, and in theory here we're saving somewhere 30-35% on each dollar. We've used $150,000 in depreciation total. Don't forget that we've wiped out the 40, right? So $150,000 in depreciation total. This depreciation is saving us roughly $50,000 in taxes, and then we can take that 50 and use it to help us move that money into the next property and keep this accumulation of assets moving. The more assets you have, generally, the more you're able to use strategies that are out there to lower your taxes. Essentially, tax planning is using the rules that are out there to incentivize certain behavior, and the federal government wants to incentivize real estate investing. That's why they created these rules, to give tax breaks and essentially encourage investors to put their money into real estate. So that's kind of the ways. These are the three ways to access those passive losses. And if any of you have questions on your situation specifically, don't hesitate to reach out so we can talk about it and figure out a plan for you. Thanks.